Okay, let's unpack this. We're taking a deep dive today into the world of, well, one of the biggest players in gold mining, Newmont Corporation. Our focus. Their recently released second quarter 2025 earnings. And our mission here isn't just, reading off the numbers. We really want to understand what makes a strong quarter for a company like Newmont. Everything from their frankly remarkable cash flow to how they're managing assets and what they're committing to down the road.
Exactly. And what's great here is our insights are coming straight from the source, Newmont's official Q2 2025 earnings release. So it gives us a really clear, data-driven picture.
Straight from the horse's mouth, as they say. Okay, so let's kick things off with the big headline. This comes directly from Newmont's CEO, Tom Palmer. He called Q2 a strong second quarter, said they produced roughly 1.5 million attributable gold ounces and generated an all-time record quarterly free cash flow, get this, $1.7 billion. He really emphasized that this highlights the, quote, strength of our world-class portfolio and the disciplined execution towards their 2025 guidance.
That $1.7 billion figure, that really jumps out, doesn't it? Record free cash flow.
It really does. Now, let's get into some more of those raw financial numbers for Q2. Reported net income was $2.1 billion, but maybe more telling is their adjusted net income, or ANI. That came in at $1.6 billion, which works out to 1.43 per diluted share. And, that adjusted net income basically smooths out one-off items, giving a clearer view of core earnings.
Right, it's a better gauge of the underlying performance.
Exactly. And their adjusted EBITDA, that's a key measure of operational profit before interest, taxes, depreciation, amortization, that stood at a pretty robust $3.1 billion.
And we sort of connect that to the bigger picture.
Yeah.
Those figures are significant. That record free cash flow, $1.7 billion, and especially that very, very low net debt to adjusted EBITDA ratio.
Oh, yeah. Tell us about that.
It's 0.1x, which is, frankly, incredibly low. It basically means their debt is tiny compared to the cash they're generating from operations. For mining, which is super capital intensive, this signals exceptional financial health. It suggests they have, significant room for future strategic moves, investments, or shareholder returns.
And speaking of returns to shareholders, they haven't been sitting still, have they?
Not at all.
Since the last earnings call, they've returned a full $1.0 billion. That's through share buybacks and dividends. And if you happen to be a Newmont shareholder listening, they declared a $0.25 per share dividend for Q2. That's payable September 29th, 2025. But here's maybe the bigger news on that front. The board just authorized an additional $3.0 billion share repurchase program.
Wow, another $3 billion. That's a huge vote of confidence.
It really is. It signals that they clearly think their stock is undervalued, and crucially, they have the cash to back that belief up.
And the very powerful signal suggests they feel extremely secure about their finances now and their future cash generation. Secure enough to commit such a huge amount back to investors.
Precisely. And, that confidence looks pretty well founded. Production-wise, their core portfolio delivered 1.5 million gold ounces and also 36,000 tons of copper this quarter. And looking at the balance sheet again, they ended the quarter with a really impressive $6.2 billion in cash, plus $10.2 billion in total liquidity. They also managed to reduce their debt by $372 million.
And that brings us back to that 0.1x net debt to adjusted EBITDA ratio. It really is a standout figure. For you listening, that's kind of like having so little debt you could pay it off with just over a month's operational earnings. It shows incredible financial agility.
Okay, so those are the headlines. Pretty impressive stuff. Now here's where it gets really interesting. Let's unpack the specifics behind these numbers. How did they get here? Let's compare Q2 to Q1. First up, gold production. Attributable gold production actually dipped 4%, came in at 1,478,000 ounces from Q1. But, and this is important, this was expected.
Right, not a surprise.
No, it was largely driven by those previously announced sales of non-core assets. They knew this was coming.
That's a really key point. It's a planned reduction, not some kind of operational hiccup. It shows they're strategically trimming the portfolio, right? Moving towards a leaner, probably more profitable operation instead of just chasing volume.
Exactly. And even with those sales cheering the total, production did grow in other important areas, which is the interesting counterpoint. Yanacocha saw increases. That was from improved injection leaching. Peñasquito benefited from higher gold grades, and both Nevada Gold Mines and Boddington saw growth too from processing more tons after some planned maintenance.
So it's a rebalancing act, really, not just a simple decline across the board.
Definitely. Now, let's look at the price they got for their gold. The average realized gold price saw a significant jump this quarter. It rose to $3,320 per ounce. That's up a hefty 376 per ounce from Q1.
Big jump, driven by the higher market price, obviously.
Mostly, yeah. That figure includes $3,301 per ounce from the gross price received. Plus, there was a favorable bump of $25 per ounce. That's from mark-to-market on provisionally priced sales.
Right, so for you, that mark-to-market bit basically means the final selling price got adjusted upwards favorably because market prices moved up after they'd made initial estimates on some sales.
Good explanation. And then there was just a minor reduction, $6 per ounce, for treatment and refining charges. Okay, what's also really encouraging is the trend in cost management. Let's talk costs. Their gold costs applicable to sales, or CAS, actually decreased 1%, down to $1,215 per ounce, and that's on a co-product basis compared to Q1.
And the why behind that?
Primarily, lower direct operating costs. And that's a direct benefit from selling those higher-cost, non-core assets we mentioned.
Makes sense. And maybe just quickly clarify that co-product basis.
Good point.
It basically means they're allocating the mining costs across all the valuable metals they dig up, like copper, silver, not just dumping all the cost onto gold. It gives you a more, let's say, precise picture of the true cost to produce each ounce of gold.
Exactly. It's a more comprehensive view.
And it's clear that divestiture strategy is directly helping that cost efficiency number.
It is. And building right on that, their gold all-in sustaining costs, the AISC, which includes sustaining capital, also decreased, down 4%. It landed at $1,593 per ounce, again, on that co-product basis.
So what drove that AISC reduction?
The main drivers were about $81 million lower spending on sustaining capital. That was both at the non-core portfolio before it was sold and across the remaining core portfolio. Specifically, less spent at Boddington after maintenance was done, and also at Lihir and Cadia, mainly due to project timing, sort of optimizing when they spent the money. There was a little bit of an offset from some seasonal cost increases you'd expect at Red Chris and Brucejack, but the overall trend was down.
This really seems to underline that strategic focus, doesn't it? Profitability per ounce. By getting rid of those higher cost assets, they're not just shrinking their footprint, they seem to be actively improving cost efficiency, boosting margins. Even if the total gold output dips slightly, it feels like a real quality over quantity approach.
Yeah, I think that's a fair assessment. And just to round out this performance section, the cash flow story, we mentioned the record number. Free cash flow surged, up 42% from the prior quarter, hitting that $1.7 billion record.
Huge increase.
Yeah. And that was driven largely by an increase in their consolidated net cash from operating activities. And that effect was compounded because they actually had lower capital investment during Q2 as well.
So more cash coming in from operations, less cash going out for capital projects in that specific quarter. Makes sense.
Exactly. So we've seen these impressive Q2 results. What does this all mean looking ahead? Let's talk strategy, the road ahead for Newmont. First, let's get an update on that divestiture program. You might remember, back in February 2024, they announced plans to sell off 6 non-core operations and 2 projects.
Right, streamlining the portfolio was the goal.
Well, they've moved fast. All those non-core operations, plus their 70% stake in the Havieron project, they were all sold by April 15th this year.
Wow, that's pretty quick execution for deals of that size.
Mm-hmm.
Shows real focus.
It does. And the money involved. Expected total gross proceeds are up to $4.3 billion. Now, that includes some contingent payments down the line and closing adjustments.
Still, a significant inflow of cash.
Definitely. They've already banked $2.5 billion in net cash proceeds just this year-to-date 2025. About $850 million of that came in Q2 specifically from selling Porcupine and Akiem. Plus, they got another $470 million net from selling some equity shares they held in Greatland Resources and Discovery Silver.
So they're well on their way to realizing those proceeds.
They are. The only piece still outstanding from that original plan is the coffee development project. That's still marked as held for sale, but no final agreement is in place just yet. Okay, now let's shift gears to their 2025 guidance and the impact of seasonality. Big picture. Newmont says they remain on track to meet their full year 2025 guidance, so good news there.
Stable outlook, despite the portfolio changes.
Right. But it's important for you listening to understand the typical production seasonality in mining. It's not always even quarter to quarter. For Newmont's core portfolio, the attributable gold production is expected to be weighted towards the second half of the year, about 50%, roughly half and half, but slightly more in H2.
Right. So for you, that means don't be alarmed if the first half looked maybe a touch lighter than the second half will. The main production push is really planned for later in the year.
Yeah.
It's a common pattern, due to mine plans, maintenance schedules, sometimes weather, project ramp-ups.
Exactly. And drilling down a bit. While Cadia and Penasquito were actually a bit stronger than expected in the first half, they are projected to see production decline somewhat in the second half. But that's expected to be offset. They're anticipating increased production in H2 from their non-managed Nevada gold mines from Yanacocha. And here's a really exciting bit. The addition of Ahafo North coming online in the fourth quarter, that's a brand new high-value project.
Ah, Ahafo North. That's been anticipated for a while. A key growth project for them.
It is. Now, capital spending also has its own seasonal rhythm. Sustaining capital for the core portfolio, that's the money needed just to keep current operations running smoothly, that's now expected to be weighted more towards the second half of 2025.
Okay.
This includes things like optimization work at Lihir, increased spending at Cadia for its long-term life and tailings storage, continued surface work up at Red Chris and Brucejack, and also a ramp-up in spending at Tanami. Development capital, that's money for growth projects, that's also projected to increase in the second half, mainly as Ahafo North moves towards commercial production, and also as spending ramps up at Cadia and Tanami on their expansion projects.
So higher spending expected in the back half of the year.
Yes. And just a quick note on what they said about the third quarter specifically. Production from the core portfolio is expected to be pretty much in line with Q2, so relatively stable. However, the AISC per ounce, the all-in sustaining cost, that's expected to be slightly higher, primarily due to that increased sustaining capital spend we just mentioned.
Makes sense. More spending usually means higher cost per ounce in the short term.
Right. And consequently, free cash flow in Q3 is projected to be negatively impacted. That's because of the higher capital spend, potentially higher cash tax payments, and also continued spending on those big water treatment facilities at Yanacocha.
Okay, so maybe a dip in free cash flow in Q3 before potentially rebounding. What's really compelling about all this forward-looking stuff is how transparent they're being. They're not just reporting the past, right? They're clearly laying out how the divestitures, the disciplined capital spending, even allowing for seasonal shifts, it's all geared towards hitting those full-year targets. And critically, bringing those valuable new projects like Ahafo North online, it really feels like optimizing the whole portfolio for future value. And, dare I say, long-term sustainability, too.
That's a perfect segue, because beyond the financials, beyond the production stats, what about the broader impact? What does this deep dive mean for you, the listener, thinking about, responsible corporate behavior?
It's really important here to look at Newmont's commitment to what's called concurrent reclamation.
Closing mines properly.
Exactly. Mines don't last forever.
That's right.
Right. So planning carefully for closure is crucial. You have to address the social, economic, environmental, regulatory impacts when mining stops. Newmont actually has a global closure strategy. Their stated aim is to create, quote, enduring positive and sustainable legacies that last long after mining ceases.
Strong words. Are they backing it up? Well, they seem to be putting serious money behind it. They spent $280 million just on reclamation activities in the first half of 2025 alone. And to give a specific example, $167 million of that was just for building water treatment plants at Yanacocha in Peru. And spending there is expected to increase in Q3 and be highest in Q4. They're actually on track, they say, to spend a pretty substantial $800 million on reclamation for the full year. And $600 million of that is specifically for Yanacocha water treatment.
$600 million just for water treatment at one site. That's a significant environmental investment.
It really is. And they also seem committed to transparency on this front. They recently published their 21st annual sustainability report and also their 4th annual taxes and royalties contribution report.
This really brings up an important point for anyone trying to understand the full picture of a company like this, understanding these environmental and social commitments, the ESG side, if you like. It's becoming just as crucial as analyzing the P&L sheet. It shows a company really grappling with its entire life cycle impact, not just the extraction phase. And that level of transparency, plus the significant investment in things like reclamation, it really highlights a shift, maybe a necessary one, towards more sustainable business models in mining. That's relevant to anyone interested in responsible corporate practices, wouldn't you say?
Absolutely. It's a critical piece of the puzzle. So let's try to wrap this deep dive up. What are the key takeaways? We've definitely unpacked Newmont's stellar Q2 financial performance, headlined by that record free cash flow. We've seen their strategic divestiture program in action, actively shaping a more focused, potentially more profitable portfolio. We've looked at their disciplined approach to cost management, getting those CAS and AISC numbers down.
Hmm.
And we've seen their clear forward-looking plans for production, for capital investment, bringing new projects online, and underpinning all of that.
Right, underpinning it all is that significant and quantifiable commitment to concurrent reclamation and broader sustainability efforts. So as you, our listener, consider all this information, here's maybe a final thought to close on. Given Newmont's really clear focus on both financial strength and this long-term environmental stewardship, how might that dual commitment start to redefine what value creation truly means in the global mining industry going forward? Something to think about.